mentioned, I'm Connie Lee from Deloitte Tax, and I will spend the next 15 minutes to discuss high-level general rules related to corporate income tax on outbound investments. And I will also provide a couple examples to compare the U.S. tax under current tax laws versus under the Biden administration tax reform. When we talk about outbound, we generally mean U.S. persons investing and doing business outside the U.S. They can do business in a foreign country through a branch, a corporation, or a partnership. For my today's discussion, I'm going to focus on U.S. corporations doing business in a foreign country through a corporation. So as you can see from the slide, I actually have a picture there, and I'm going to use this structure to explain a couple changes throughout the U.S. international tax history. So in this picture, I have a U.S. corporation that owns 100% of a foreign subsidiary 1, and also 100% of a foreign subsidiary 2. They can be formed in any countries outside of U.S. So as you probably can see from the slide, on the left side, you have 1962 Revenue Act, Tax Reform Act of 1986, and 2017 Tax Cuts and Jobs Act. Of course, U.S. has many tax reforms throughout the years. I have only listed the major ones here. So before 1962, before the Revenue Act, in the picture, let's say if a U.S. corporation sells its inventory to a wholly owned foreign subsidiary, for example, if it's formed in Bermuda, it's a Bermuda corporation, which then resells the inventory for a huge markup around the world. The profits earned by the Bermuda company is not taxed in the U.S., is not taxed in Bermuda, is not taxed anywhere. So this is how it works prior to 1962. Now, the 1962 Revenue Act introduced controlled foreign corporation and subpart F rules. So in my picture again here, because the U.S. corporation owns more than 50% of foreign sub 1 and foreign sub 2, foreign sub 1 and foreign sub 2 are both considered controlled foreign corporations and therefore subject to the subpart F rules. So what this subpart F rules does is it painted the forms of income earned by a controlled foreign corporation on a current basis. So in my example, prior to 1962, foreign sub 1, which is a Bermuda company, when U.S. sells products to it and it has a huge markup by reselling the product to the world, nothing was taxed, right? The foreign subs earnings not taxed anywhere. 1962 Revenue Act changed it, and it says the income earned by foreign sub 1 is subpart F income, and therefore should be taxed in the U.S. currently. So that's the big change from 1962 Revenue Act. Now let's jump to the next tax reform, which is a huge one. It's called Tax Reform Act of 1986. So under this Tax Reform Act of 1986, the subpart F rule actually got extended, to expand it to cover more areas. So in the same picture again, U.S. would tax on the net income earned by U.S. corporations. The local country would tax the earnings earned by foreign sub 1 and foreign sub 2. But remember, we have subpart F rules. So subpart F rules makes U.S. can tax the income earned by foreign sub 1. Now, let's assume foreign sub 2 doesn't generate any subpart F income. It only generates non-subpart F income. So under this 1986 Tax Reform Act, U.S. does not have the right to tax the earnings by foreign sub 2 unless there's an actual repatriation from foreign sub 2 back to U.S. So that's the 1986 Act. So again, under this 1986 Act, earnings from foreign sub 1 is taxed in US currently, while earnings from foreign sub 2 is deferred and not taxed in US until there's an actual cash repatriation. Now, the next major tax reform is called 2017 Tax Cuts and Jobs Act, TCJA. So this TCJA brought in a lot of international key provisions. The first one I would like to introduce is, the one-time transition tax. So that's the second bullet point on this one. Remember in my prior example where under 86 Act, earnings by foreign sub 2 is not currently taxed in the US until there's an actual repatriation. So this 2017 TCJA Act changed this. So under 2017 TCJA Act, all of the untaxed earnings earned by foreign sub 2 from 1986 to 2017 would be taxed by the US as a one-time tax. Now, after that, if you want to actually repatriate tax back to the US, it would be mostly tax-free because US allows for a dividend receipt deduction of 100%, right? So, and also because all of the earnings were already taxed under this one-time transition tax, so repatriation should be tax-free other than some FX gains and losses. The TCJA also introduced another key provision for international tax area is called GILTI, or Global Intangible Low Tax Income. So basically, back to my example again, where I said foreign sub 1 generates subpart F income, foreign sub 2 generates non-subpart F income. So it started after the one-time transition tax, starting from calendar year and 2018, earnings earned by foreign sub 2 would be taxed currently in the US under this key provision called GILTI. And then another key provision that would impact quite a bit of clients, US multinationals, is this foreign derived intangible income. And I will give an example when we talk about FDII in the next couple of pages. So next, let's talk about, we all heard about Biden administration tax reform. So that's another big one that we are expecting. So in the next few slides, I'm going to show you the comparison between the current law and also the Biden Green Belt. So I am going to talk about the three major ones that impact a lot of my clients, but other provisions are also listed here that may impact you or your company. So in the interest of time, I'm only going to focus on three. So the first one is the US corporate tax law. You probably already heard about this. Under current tax law, US corporations are taxed at 21%, but under the proposed change for next year, US would be taxed at 28%. So that's a 7% increase. The next change is called GILTI tax rate. Remember, GILTI is regarding the earnings by foreign sub 2 in the prior picture. So under current tax law, GILTI tax rate is 10.5%, while under the proposed law is 21%. Now, there are also two key changes impacting the GILTI calculation. So the first one is called per country calculation. So under current law, let's say in my foreign sub 1 where I generated loss and foreign sub 2 generated income, I can aggregate the two and only report the net tested income as GILTI in my GILTI calculation. Under the proposal, the Biden Green Belt proposal, GILTI would have to be calculated on a per country basis. So if foreign sub 1 and foreign sub 2 are formed in two different countries, you cannot net loss from one sub to income from another sub. So that would substantially increase some of the company's GILTI calculation. The second impact would be in the current law, it allows a 10% return of tangible assets under current law where it would not be subject to GILTI. Now, under the green book, it's eliminated. So let's say if your foreign sub 1 has tangible assets, it generated, income, 10% of that income would be exempt in the GILTI calculation. When under the proposal, if it's eliminated, that would increase your GILTI basis. So those are the 2 items. The third item that I would like to discuss is called FDII, Foreign Derived Intangible Income, and that's on slide number 5. And so we call it FDII or FDII, as you can see on the bottom. So basically, the concept is that if a U.S. corporation sells 2 products only, and both products are exactly the same, and they generate the same profit, but one product is sold to a U.S. customer, and one product is sold to a foreign customer to be used outside of the U.S., the tax rate is actually different, even though they are both reported by the U.S. corporation. So the profit that's generated from the sale to a domestic customer is subject to the 21% tax rate. The product that's sold to the foreign customer is actually subject to a lower tax rate. And you can go as low as 13.125. So this is a benefit that's offered to a lot of U.S. corporations. But under the Biden Green Book, this FDII benefit is repealed. So this would have a big impact to U.S. corporations as well. So the next few pages, I have listed quite a bit of difference between the current law and the Green Book, but I'm not going to go over here in the interest of time. So I would like to actually explain to you 2 examples. And in these 2 examples, as you probably can see, I'm going to show you the U.S. tax liability between current tax law and the Biden administration tax reform. And I am only going to show you the U.S. federal tax rate change from 21% to 28%, and also the GILTI tax rate change from 10.5% to 21%. And then also the 2 key components that I discussed earlier, which is a country-by-country calculation under the tax reform, the new tax reform that we are expecting, and also the elimination of the 10% of the QBI. So because of those 4 different changes, if you will see that the U.S. tax rate tax expense would actually increase by more than 50%. So in my example, and you can look at it later, I am not going to walk through step by step, but basically in this example, you have a ABC US owns 100% of ABC APAC and 100% of ABC EMEA. And the facts and the assumptions are the same for both examples. And the income are also the same. The tax rates are also the same. Local tax pay are also the same because there are no changes to the local tax, right? It's 20%. So local tax is also the same. But because of the U.S. federal tax rate changes, GILTI tax rate changes, like I said, in the middle column, the last row, you can see that the U.S. tax liability actually changed. So in this current law, it's only $210,000, and this $200,000 is really the 21% times U.S. domestic income of $1 million. Now, the GILTI income, you know that we said GILTI would be taxed in the U.S., but because of how it's working under the current tax law, the foreign tax credit, which is taxes paid in local jurisdiction, is sufficient enough to offset the U.S. residual tax on GILTI. So we did not have to pay anything extra. Now, if we go to the Biden proposal, you will see that actually the tax change from $210,000 and to the next page is actually $330,000. And this is because, one, the federal rate change. So even with $1 million U.S. domestic income at 28%, you have to pay $280,000. And in addition, because of the way how guilty is calculated, you actually would have U.S. residual tax on guilty. So the tax rate increased by more than, I'm sorry, not tax rate, the U.S. tax liability increased by more than 50%. So that's all from my presentation. I hope you enjoyed it. If you have any questions, maybe we can talk about in the Q&A section. Back to you, Winona.